everybody. Good afternoon and happy Friday. Thank you so much for tuning in to be with us here today. My name is Danny Haig and I'm here with Neil Woodford. Today, what are we talking about? Well, you've probably guessed it. We're going to be talking about tariffs. But not only that, we're going to reflect on Q1 and look at Neil's previous podcast and see what has changed and what has stayed the same. We're also going to be getting Neil's insights into the global economy and also markets for the upcoming year. We'll be touching lightly on the Magnificent Seven. And of course, we couldn't let you leave at this time of the year without talking about those three top picks for ISA season. So without further ado, let's get started. So Neil, in your January webinar, you identified some key trends that you believed would shape the investment landscape in 2025. You were really clear. You said, avoid the Magnificent Seven and any passive exposure to the S&P 500. You also warned us that the US market was overvalued and likely to deliver weak real returns. Not necessarily through a crash, but more through long-term stagnation. Now, both have certainly underperformed this year, but I'm sure with so much volatility, investors might say it's been more crash-like than perhaps you suggested. So can you take us through what you thought then and what has now changed?
A lot has happened. I'm going to touch first on the economic view briefly that I outlined 3 months or so ago, and then talk briefly about markets. And just to summarize what I said on economics, broadly I said the US economy would continue to grow well, and it would appear still to be growing well. It finished last year, 2024, with good economic momentum, growing at something like 2.5%, and that's been carried on through into the first quarter of 2025. But of course, there are lots of things that have happened recently that may impact people's views about what's going to happen for the remaining 9 months of this year and into 2026, and I'll touch on that later. But broadly, the US economy has performed as I thought it would. I also talked about China back in December, January time. The Chinese economy is confronted with lots of challenges, but I said then, and I would say again now, that the stimulus package, which is a sort of rolling series of measures, and we'll be hearing more about that in the next few weeks, I imagine, in the light of the tariff announcement. But that rolling package of measures from the Chinese government will, I think, address some of the key challenges that are confronting the Chinese economy. And I am more optimistic than consensus about the ability of the economy to sort of work its way through those fundamental challenges affecting the property market, affecting consumer confidence and consumption growth. So I said then I was more confident about the Chinese economy, and I would remain more confident about the Chinese economy going forward. And I'm eagerly anticipating the next set of announcements about what the fiscal measures will be. I also touched on the UK. I've been more bullish than consensus on the UK for a period now. And to some extent, I was disappointed really by what happened in the aftermath of the general election. The new government basically engaged in a sort of, I don't know what was motivating it, but engaged in a sort of in an economic narrative that was talking everything down. I think it was in a way that they were engaged, I think, in a sort of expectations management exercise. But ultimately, talking the economy down didn't have a good impact on business or consumer confidence. And as well, the budget in October, right at the end of October last year, was a very disappointing budget. It resulted in significant increases in tax on the corporate sector, and it created an inflationary bubble, effectively, which is sort of working its way through the economy right now. But that wasn't very helpful either. So the UK economy has pretty much stagnated since the summer of last year. But interestingly, I said at the start of the year, and I would say again today, I still remain more optimistic. about the outlook for the UK economy, and I still think we're going to grow ahead of the OBR and the MPC's forecast. I still think we're going to deliver something between 1.25% and 1.5% growth this year, and we'll accelerate next year, and I still believe that. I'm not going to go into the detail right now about why I think that, but broadly, consumption growth is going to be the engine of growth for the UK economy.
Well, I hope you're right on that.
Okay. And then finally on Europe, which was the other area that I covered, I talked about the challenges the European economy confronts, and those challenges are still very much in place. And of all of the sort of knock-on effects of Trump's tariff announcement, and I'll again come onto that in a bit more detail later, but Europe is going to be pretty profoundly affected, particularly the German economy, which is so export dependent. So I'm a little more concerned about the outlook for Europe than I was back then, but there has been some mitigation, and that mitigation is really again a product of Trump's sort of geopolitical strategy, which is basically to stand back from the war in Ukraine and supporting Ukraine, and pretty much say, over to you, Europe. You've really relied too much and for too long on the US sort of defense umbrella. You've got to step up. You've got to start spending more on defense. And that's triggered a significant sort of movement, really, in Germany in particular, which has initiated a significant fiscal program which will roll out over a number of years. But the net product of all of that is that more money is going to be spent on the economy, more money is going to be spent on defence, and I think that is some mitigation for the headwinds that the European economy confronts. Broadly, in summary, the upside in terms of more defence spending, more infrastructure spending, particularly in Germany, that will take time to come through. So it would be unwise to expect the European economy to suddenly accelerate from here. But in time, I think, on a medium-term view, I think those fiscal measures are going to drive a better growth outcome for Europe. So those were the key pillars of what I said at the start of the year. And moving on now quickly to markets. You're right, Danny. I said I suppose my biggest call was avoid the S&P 500, avoid the Mag 7. I think the market's overvalued, and I think it's going to underperform. I didn't anticipate the level of correction that we've seen now. I mean, the first quarter's been pretty ugly, really, for the US market. Nasdaq's down, I think, 14% since the start of the year. The S&P is down 8.25%. So, not a good start for the first quarter, or a little longer than the first quarter. Interestingly, what I also said back then is that the UK market would outperform, and it has outperformed. The UK market is up year to date. So is Europe, which was something of a surprise, and China and Hong Kong markets have been better as well. So broadly, my calls were, I like China, I like Hong Kong, I like the UK. They have broadly played out as I had anticipated. Until the last few weeks, the outturn was looking really quite good, but the Trump tariff concerns have rippled across all markets globally. So everything's come down recently in the last few days. But nevertheless, I was right to call the outperformance of Hong Kong, the outperformance of China, and the outperformance of the UK. What I got wrong was that I wasn't that positive about the European stock markets, and they have actually done pretty well. And I think what's triggered that are two things, really. First of all, the fiscal package that has got investors quite excited about defence stocks across Europe in particular, defence and infrastructure stocks, and that's helped the market. And then alongside that, I think also the interest rate cuts that the ECB has implemented, I think have helped the market start to get a bit more optimistic about the future. And the ECB has cut more aggressively than has, for example, the UK Central Bank. So broadly, what I said back then, I would say again now. I would still avoid the S&P 500. I would still avoid the Mag 7. I still think the overvaluation has more correction to come, if you like. But as for sort of calling, what's going to happen in the very near term, it's very hard to make a definitive call. We've got a pretty heightened level of hysteria in global markets as a result of what Trump announced on Wednesday. I'm going to come on to that in a bit more detail later. But my fundamental calls are the same now as they were at the start of the year.
I don't think we can hold off any longer from talking about tariffs. Wednesday was, of course, Liberation Day. I think it's fair to say that President Trump's tariffs have really, taken and captured headlines and people's attention across the world. But before we dive in, I think it would be really useful for everyone, certainly me as well, to understand a little bit about the history of tariffs. And, maybe give us a little bit of an economics lesson on that.
Well, I don't want to be too boring about tariffs, but there's a long and interesting history of tariffs. Tariffs have been used, particularly by the US economy, by the US government, really as a sort of fiscal or a sort of geopolitical weapon for the last 2 centuries. And they've been quite volatile. I mean, in the early 1800s, tariffs were very high. They then came down. Then they went up again at the end of that century. They became, in a way, I think the president at the time was McKinley. I remembered, actually, he was assassinated eventually. But anyway, McKinley used tariffs.
Because of his tariffs?
I'm not sure. I needed to check it out. But McKinley used tariffs particularly as a tax-raising measure to avoid the need to levy an income tax. And this is perhaps why Trump likes him so much.
Right.
So anyway, McKinley was very keen on tariffs. Some people look back at the very high tariff levels that were introduced in the 20s as a result of what was called, I think, the Smoot-Hawley Tariff Act. Those tariffs, some people believe, contributed to the Great Depression in the US economy. And thereafter, pretty much since the sort of post-war period, post-Second World War period, tariffs have reduced significantly year in, year out, broadly. And the General Agreement on Tariffs and Trade, the end of the Bretton Woods agreements, all these things gradually resulted in lower and lower tariffs. And we've had a very low tariff environment really in the global economy now for the last 50 or more years. And all of that has now apparently changed as a result of what Trump has introduced. It's still early days, and it's still hard to know exactly what's going to happen next. There's a slightly lower level of uncertainty in that we now know what the measures that Trump would like to introduce, and there are 60 countries with 60 specific tariff rates, and everybody else is going to be levied at 10%. Now, if you aggregate all of those rates, and by the way, these are tariffs levied on traded goods, not on services, on traded goods. And if you aggregate all those numbers, I've seen forecasts vary between 18 and as high as 30% as the sort of the aggregate tariff rate that will now be levied on exports to the US economy. I'm not sure what the number will be, but that range tells you that people, even sophisticated forecasters, are struggling to get a precise measure of what this all means.
Yeah.
And of course, they were only announced on Wednesday, and pretty much every government around the world, particularly in those 60 countries that have been targeted with specific measures, will be looking to engage with the US administration to try and negotiate a reduction in the headline tariff rates. So as I've said, I think it's early days to make too many definitive conclusions about what the outcome is going to be. But clearly this is a significant break from historic, from modern economic history's relationship with tariffs, if you like. And we are in a new and a more challenging era as a result of that. But I think it's really, really important at a time like this to sort of keep a level head, because there's a lot of concern, there is a lot of worry now in financial markets. There's a lot of media attention on what Trump has announced. And I think much of what I've read is frankly hysterical.
Yeah.
And so I would want to use today's podcast to try and create some context around the debate. Let me give you some facts now about what just some brief facts about what's been introduced. First of all, the tariff measures that were announced, specifically on the 60 countries that were highlighted in his Rose Garden speech. Those 60 countries, the tariff measures, the tariff percentages are at the high end of expectations, very much at the high end of expectations. And particularly, I think we need to focus. I mean, of course, if you're the Vietnamese government or the Cambodian government, you're going to be very concerned about the 45 or more % tariff that is now going to be levied on your exports. But as far as the global economy is concerned, I really want to focus really here on China, the EU, and the UK. Again, those areas that I've tended to focus on in the past. Now, China's tariff rate of 34% is on top of the 20% rate that was introduced prior to this announcement. So the tariff rate on Chinese exports is now something like 55%. Some goods, by the way, are excluded. So about a third of traded goods are not included in this announcement. But nevertheless, this is a penal level of tariffs on Chinese exports. My expectation is that the first thing that will happen is that President Xi and Trump will now sit down and negotiate with each other. Who knows where that will end up? But this is, I think, fundamentally not particularly good news for Chinese exporters. But remember what I said at the start here. Remember that the Chinese government has had plenty of time. Really, it's been talking about this since last September. It's been talking about what it would do if Trump introduced these sorts of measures. And I've also mentioned that the policy response we're going to see in China is going to be bigger and more significant, and the objective of the policy response is to stimulate the domestic economy. So if you're a Chinese exporter, life is going to be more difficult for you if you're exporting to the US, and you've got some important decisions to make about how you approach that activity in the future. But for the Chinese domestic economy, I think this is less of a challenge because of the offsetting measures. For the EU, this is not helpful. The EU is a much more export-dependent economy, particularly Germany and Italy are very export-dependent economies. Manufacturing exports form a very important part of their economies. And there are going to be some challenges now, more incremental challenges. But again, I think it's too early to draw too definitive a conclusion about what the damage will be and the permanence, for example, of that 20% rate. Clearly, the first thing that the European Union will do is, first of all, threaten retaliation, but I think the first thing they're going to do is going to sit down with the Trump administration and try and negotiate a better outcome. As for the UK, this is where I want to give you some sort of concrete facts to try and put some context around what people are very concerned about. And leading up to the announcement, of course, we had the Chancellor talking about a much more uncertain world. We've had the OBR talking about the potential harm to the UK economy from tariffs. But let me just give you some numbers. So the UK exports £60 billion worth of goods to the US economy. And a significant part of those exports are luxury cars, basically Rolls Royces, Aston Martins, things like that, which are less price sensitive than perhaps everyday normal cars. Now, let's assume that the full 10% is levied on those £60 billion worth of goods exports. That's a £6 billion effectively hit, if you like, to the economy. So to put that in context, the UK economy is a £2.56 trillion economy. So the hit to the exporters is 0.002% of GDP. So it's very small. And just again, to put some more context around this, last year alone, UK households added £200 billion to their bank deposits.
Wow.
So I'm not suggesting that this is going to be an easy thing for Rolls-Royce or Aston Martin to overcome. But what I'm saying is that for the overall UK economy, this is less than a rounding error. This is not going to destabilise the UK economy at all. There are much more important things driving the UK economy, which will overwhelm the impact of higher tariffs on UK exports to the US economy. And that's before Keir Starmer and Donald sit down and have a chat about how they can agree some sort of free trade agreement. So I think the hysterical reaction I've seen in the UK media about this is terribly damaging for the UK economy is just factually wrong.
Yeah.
These tariffs are just not big enough, and our manufacturing exports, our goods exports to the US economy are just not big enough for these tariffs to have that much of an impact on the UK. In fact, I don't expect to have any impact at all on the UK economy. And let's also put some context around this. I did a lot of reading yesterday in the wake of the announcement, and as everybody will understand, that the automotive industry is sort of at the heart of Trump's measures to make America great again, to try and get manufacturing industry to sort of relocate in the US. He wants US consumers to buy US-made cars, etc. Now, there's a 25% tariff on all car imports into the US, which was a separate measure announced prior to Wednesday's Liberation Day announcement. Now, what is interesting is what I've heard from 3 automotive manufacturers, what they're going to do in the light of these changes. So the first was VW. VW export a lot of cars to the US, and what they've decided to do right now is to basically hold everything either at port or in railhead sort of storage centres and decide what they're going to do on pricing. So they're not actually going to be selling any cars for the time being. They're going to wait, decide what they're going to do, and then start to reprice their product. Seems like a sensible decision, but we don't yet know what the pricing response will be to the 25% import levy that is now going to be applied if nothing changes. But interestingly, Hyundai, which is also a Korean-based exporter of cars to the US economy, Hyundai announced that they have no plans to increase prices at all, which is interesting. Yeah. But perhaps even more interesting than that is Ford's response. Ford have announced that they're going to be cutting prices on cars. What they're going to be doing is providing to all customers, the discounts that Ford employees get when they buy a new Ford car. So they're going to extend that program out to all customers. Now, there's a really interesting example which tells you that it's way, way too early to draw definitive conclusions about what's going to happen, how companies are going to react, what these levies are going to mean. In the automotive industry, there are 3 great examples. Hyundai's not going to increase prices at all. They're going to take a hit clearly on profits on exports to the US, and Ford are going aggressively to capture market share by cutting prices. So it's a great example of why you need to look behind the headlines to try and understand what's really going on, and it's way, way too early to be too definitive. But my guess is that the inflationary impact or the price impact and the conclusions that people are drawing right here, right now, in the immediate aftermath of the announcement are just wrong. Okay. But there'll also be lots of substitution effects, and the idea, I think, what the sort of the argument that I want to pick with consensus at the moment is that these tariffs will create a US recession. I'm going to touch on that in a bit more detail in a minute, but I think I need to talk in the context of this tariff discussion right now about some of the offsets. Now, I've talked a little bit about what's happening in the automotive industry, but there are other important substitution effects. There are always substitution effects when relative prices move in an economy. and it's important to keep sight of those. So people will substitute domestically produced goods for goods that they might have bought that have gone up in price because they were imported.
Yeah.
Those substitution effects are really important, and they're important because, again, my fundamental view is that these tariffs will not create the inflationary, sort of stagflationary environment that many consensus forecasts are now saying will happen next. So I'm much less concerned about the inflationary impacts of the tariffs. So substitution effects are really important, but there will be other offsets, and the two most important offsets really come back to what I've been saying for a while, which is if the US economy slows, the Fed will cut rates, and the Fed will cut more aggressively than it would otherwise have done, I think, now, because I think it is probably, I agree with the consensus view that this is not good for US economic growth, and the US growth was going to slow anyway in 2025. So the Fed is going to cut. That's going to be an important offset. The second important offset is, and this is something that I thought would happen, but maybe not quite so coincidentally on the day of or the day after the announcement. But for those of the viewers who are watching the oil price, they may have seen that the oil price fell dramatically yesterday, fell by more than $5 a barrel, which is a pretty unprecedented move. And it fell because OPEC have decided to significantly increase output, not because they're trying to join in with the sort of Trump tariff party, but because they're going to punish people or countries that are cheating on their quotas, which apparently include Kazakhstan and Iraq. So oil production is going to be increasing significantly, and oil prices are falling. And today, my understanding is that they're below $70. I think they've touched $68 a barrel, which is the lowest for over 3 years. So another mitigation. Yeah. Importantly, it's important to keep a perspective on inflation. As I've said, I'm much more relaxed about inflation than the consensus. And the three key drivers of inflation are food, energy, and housing costs or rent. And really, tariffs have no impact on those three things. And in fact, my view is that with lower energy prices, you'll probably see lower food prices too. So I think the inflationary concerns have been massively overdone, much more relaxed about inflation. That's going to create, I think, the room for Fed to cut rates that will mitigate for the potentially slowing economy and the potentially damaging effects of higher tariffs on US growth. And there's one other final thing I should say as well, which is let's not lose sight of what Trump is really doing here. The slogans I've heard is tariffs equal tax cuts, and people are thinking, well, no, actually tariffs are effectively a tax on consumers, which they are. But tariffs are the route to Trump's tax cuts. He fundamentally won the election on the Make America Great Again agenda, but importantly, the core part of his agenda, his economic agenda, was I'm going to cut taxes. Now, he knows he can't cut taxes because without raising some sort of revenue. The US budget deficit is 6.5% of GDP, and the US government has borrowed more than it should have probably have done, as all developed economies have done post-COVID. So there isn't the headroom really to cut taxes without raising revenue from somewhere, and this is why he's very much in love with the tariff sort of argument, because the tariffs will raise revenue, and that revenue will be used to cut taxes. So down the line, an additional stimulative measure will come from tax cuts. So I think people are myopically focused on, oh my God, this is the sort of, this is a break with history, yeah. and I don't pick a fight with that. It is clearly a significant change of direction, yeah. And these tariffs are much, much higher than we've experienced in my lifetime. But there are important offsets. We're at the start of a negotiation. I don't expect these full headline rates to endure. They'll be negotiated down, I believe. But importantly, as I just said, there are many offsets, not least the tax cuts that will come from the revenue that is raised from the tariff tariff taxation that is now implemented in the US economy.
Brilliant. I could just listen to that all day. I have so many questions. It's amazing. And I think it's so important when you do take away the emotion of the finances. You know, when you hear the hysteria in the news and it, you know, it does make you feel something. And then when actually you look behind and you do the research and actually things aren't quite what you're told they are, which is really fascinating. So let's look ahead. Let's move onwards to the economy and markets. So we're quarter of the way through the year now, and for a lot of investors, it's certainly been a roller coaster of a quarter. So is the dust starting to settle around some of those big uncertainties, do you think? You know, like rates and tariffs and geopolitics. And what do you think we should be expecting for the rest of the year?
It's a big subject, and I could probably talk for maybe 2 hours.
I believe you.
And there is a huge level of hysteria in markets and in politics, geopolitics at the moment. It's been a very, very busy and significant first 3 months of 2025. I mean, you know, just what's going on with respect to Trump and his approach to his defense strategy, if you like, and forcing the European economies to sort of step up. You know, his stance on Ukraine and the war, you know, has been really interesting. What's going on, you know, trying to catalyze a sort of peace negotiations, and the deals he's trying to strike, you know, have created lots of ripple effects. So it's been a hard quarter to really to sit on top of and to really try and understand everything that's going on. It's busy, but as I look forward, I think it would be easy to be, it's a great word, I like it, discombobulated by the announcements this week. And what I've tried to say already today is sort of just keep calm, everybody. This is not the end of the world. This is not the sort of, I think, global economic crisis that many people are suggesting it is. So let me give you a sort of more definitive view on the sort of the four critical areas: your outlook for the US, outlook for China, outlook for the EU, outlook for the UK, and then I'm going to touch on markets. So I've sort of hinted at this already in terms of, you know, what I said right at the start, but I don't believe the US economy is going to go into recession, and I don't believe that inflation is going to rip. I think central banks are pretty relaxed about the impact of tariffs, and certainly my reading between the lines, I've listened and read what Powell has said about tariffs. And of course, to some extent, he was in the dark when he was commenting about tariffs in the past, because of course he didn't know what Trump was going to announce. But I think you can get some hints from what he said before about what his thought processes are like to be in the light of tariff announcements. And my view is and put quite simply, is that essentially tariffs raise the price of some goods relative to the price of other goods. That, to my mind, is not a whole economy inflationary event. It's, as I've touched on before, it's going to lead to all sorts of substitution effects. It's going to lead to all sorts of other types of behavior which are not necessarily inflationary. For example, take the Ford example. I'm going to capture market share by cutting prices. Yeah. So I am much more relaxed about whole inflation in the US economy. And just as the UK MPC has looked through the one-off inflationary implications of the budget measures that were announced last October, I think the Fed will look through the one-off inflationary implications of the tariff announcements. And when the Fed sit down and think about the key drivers of inflation, food, energy, and rents, housing costs, as a proxy for housing costs, I think they'll sit back and be more relaxed, not least because, of course, energy prices are heading down and heading down quite aggressively. So my view on the US economy is there isn't going to be a recession. The economy will slow this year, but it will continue to grow well and will probably outperform most European economies and the UK in 2025, sorry. So growth will slow, but it will still be strongly positive, and inflation may pick up a little bit, but I think the Fed's going to be very relaxed in the short term. Inflation will pick up a little bit, but the Fed's going to be pretty relaxed about inflation, and I think the Fed will cut rates through the remainder of this year. So I think the US economy looks set okay, and I completely do not buy into this idea that the US economy is about to fall off a cliff and crumple under the weight of the tariffs into some sort of stagflationary environment. I don't believe that. Tariffs are a challenge they're clearly not a positive for China or the EU, which export a significant amount to the US. They're going to be headwinds for those two economic areas, but there will be mitigation. And as I've said, in China, the mitigation will be domestic economic stimulus in the form of fiscal measures specifically targeted at domestic consumption growth, and that's what we've been waiting for a long time. And I expect the Chinese economy to sort of weather this turbulence pretty well. Obviously, there'll be challenges for companies that are dependent on exports to the US economy. Let's wait to see what happens in the discussions that take place between President Xi and Trump. President Xi has threatened retaliatory measures, so let's see what they are. But my best guess is that the outcome will be less bad than it looks as the headlines suggest today. And I am. Well, I'll come on to financial markets in a minute, but I'm again more relaxed about the outlook for China than most are, and I think these domestic stimulus measures should not be underestimated. As for the EU, I have said the EU economy is struggling with political and structural headwinds, and the tariff measures are not going to help. There are mitigations, and the mitigations I've mentioned already, but just to reiterate, a huge fiscal stimulus package coming in Germany, which I think will ripple out across the region. Other countries are less flexible from a fiscal point of view. Clearly, Italy and France are in no position to fiscally stimulate, but nevertheless, Germany, the influence of Germany should not be underestimated. It's the biggest economy by miles across Europe. So the fact that Germany is embracing a sort of the biggest fiscal stimulus measures since reunification shouldn't be underestimated, but it's not going to impact Germany straight away. Although the commitment is there, and I think that will play out in Germany over the next 5 to 10 years. It's not going to play out in the next 6 or 9 months. Yeah. And of course, tariffs will be a challenge in the near term. And for the UK, I've said it already, and I'll just sort of reiterate briefly. The tariff impact on the UK economy is not even a rounding error. It's just not relevant. And anybody who tells you that they're very, very concerned about the outlook for the UK economy because of Trump's tariff announcement, I'm afraid they're not really thinking clearly, in my view. So I think the numbers speak for themselves. The outlook for the UK economy is I think much better than the consensus view, certainly much better than the OBR, certainly much better than the MPC think. I think 1.25%, as I said, to 1.5% growth this year, and catalysed principally by growth in household spending, and that's going to be catalysed by lower rates. And whilst we're at it as an early call, I think the MPC will cut early in May, and I think they might cut by 50 basis points. It's a bit of an outlier call. I've said the MPC will cut 3 more times this year, but I think they might have the bravery to go for 50 bips. It's needed, it's required, and they should be doing it, but whether they have the inclination to do it, I'm not quite sure, but they may go for it. So lower rates in the UK, that's going to trigger a shift, if you like, in household spending and saving behaviour, and I think that will be the engine of growth that will drive the UK economy. And as for markets, well, look, markets have had a pretty hysterical reaction to Trump's measures. I mean, a 6% down day on Nasdaq is unusual, and markets all around the world have had, some pretty big falls. Individual stocks have. I mean, I've been tracking the performance of one or two individual stocks, and it's sort of hysterical, frankly. But markets have a long track record of being hysterical in the wake of these sorts of announcements. I think the markets are inherently irrational around these sorts of events. And so I think it's important that people don't draw too many conclusions when they turn on their screen and look at the share prices of their investments and think, oh my God, it's down 10, 15, whatever percent. Oh my God, I must sell it. I think they've got to think very, very clearly about what to do. And as I hinted at the start of this meeting, I'll say again, really the calls that I outlined 3 months ago are the same calls I'd make today. I still like UK equities. They're still profoundly undervalued, and I think they'll continue to do much better than other markets globally, and I think they'll do better in absolute terms as well. So it won't just be a relative call, it's an absolute call. I think there's a lot of upside in UK equities. I think the same for Chinese equities. I think the Chinese tech sector looks really interesting. I've talked about this many times since last January, and I think there's huge valuation upside in some of those leading tech stocks in China. I would continue to avoid the Mag 7. I'm going to touch on that specifically in a few moments. I will continue to avoid the S&P 500, and albeit that I was wrong about the outlook for the European equity markets, which I was more bearish about, and they've performed pretty well, up I think so far year to date something like 2.5-3% year to date, which is better than I thought they would do. I'm not tempted to take a sort of an index position in Europe at the moment. I think there are some headwinds that we need to sort of see play out before I get more persuaded that Europe is the place to park your money. Having said that, I've also said repeatedly that there are some really interesting special sits and sectors, really interesting sectors in both the US and in Europe, and I've written about those and I'll be writing more about them, but there are really interesting examples. I mean, one company that stands out I was really interested in, I was interested in the valuation of Mercedes-Benz, which everybody would sort of think, oh my God, it's right in the firing line right now. Yeah. It's being challenged by Chinese EV dominance. It's being challenged by tariffs. It looks like a very challenged business, but its valuation more than reflects that, and I'll be writing more about that in the future. So broadly, my calls are the same as they were at the start of the year. I'm not changing my view. What I would say, though, having seen markets correct in the way that they have everywhere in the last few weeks, and particularly in the last few days, is that there's significantly more upside as a result of that correction, because I don't see this correction enduring. I see markets regaining some stability in the wake of this announcement. Brilliant. So normality will return. Yeah. Maybe not today, maybe not tomorrow, maybe not next week, but it's going to return.
Yeah, amazing. I love that kind of positivity compared to what we're hearing in the news, which is brilliant. Okay, so we've had a lot of questions from subscribers with regards to the Magnificent Seven. Now, back in January, you said, don't touch them, don't buy them, don't trust the past to predict the future. But the fact is, many people will have those shares. So what do you suggest? Do you think that the valuations have come down enough now that it's getting a little bit interesting and perhaps, could be an interesting choice? Or what's your opinion?
Okay, the Mag 7 always feature in any discussion about asset allocation, equity portfolios. And it's for the very simple reason that the S&P is about 70% of the global index, and the Magnificent Seven are about a third, just approaching a third of the S&P 500. So naturally, if people are taking a sort of an index view of the world, equity markets, they're going to naturally have holdings in the Mag 7. And of course, because they've been so good for so long, lots of people have got them in their portfolios. Now, I said when I said what I said about the Mag 7, I was caveated my comments by saying I don't expect a crash, if you like. This is not my negativity about the outlook for the Mag 7 wasn't I wasn't describing a sort of 2000 tech crash type event. I just think these stocks will spend a long time underperforming other stocks. And although the correction that we've seen year to date in those 7 stocks is bigger than I would have anticipated, I think on average they're down about 20% since the start of the year, which is more than I would have thought. The valuations still, to me, are not yet appealing enough to persuade me that these 7 stocks should feature prominently in a portfolio. So my conclusion today is they're looking better value than they were 3 months ago, but they still, to me, do not look attractive, nearly attractive enough relative to other things that I think are looking very attractive. So I think obviously for people who are holding them, they now have a more challenging sort of decision because the stocks have come down 20%. That's never a nice experience for an investor, and they're wondering, oh my God, could they fall another 20%? And should I sell them today or should I hang on? Should I buy more because they're going to go back up again? Yeah. These are really tough questions, and as I've said, sentiment, I think market panic that we've seen in the last few days will calm down. So I wouldn't be surprised that when markets calm down, when they sort of regain their equilibrium, which I think they will do quite quickly, these Mag 7 stocks could well rise in price with that sort of recovery in sentiment. But I still believe that on a longer term view, and I'm talking all my sort of recommendations are really importantly in the context of a medium and longer term view. This is not what's going to happen in the next few weeks. I'm thinking about what's going to happen over the next 1 to 3 years, maybe even 5 years. And I would still say the Mag 7 will underperform. The valuations are challenging, still too high in my view, and fundamentally the businesses are grappling with some really interesting challenges, all of them individually. I think of all of them, I think Nvidia probably has perhaps the most attractive, for me, the most attractive and robust business model right here, right now. But what concerns me is that a company that has a 96% market share in its core market and that is now going to confront competition and which enjoys the sort of margins you'd expect when you've got a 96% market share, even though I think its customers are going to be spending hundreds of billions of dollars on chips that they need to buy for their AI models, etc., and all their data centers. Despite the fact that the demand for their products is going to grow significantly, I'm more concerned about price, competition, margin, and those impacts, and that's what makes me nervous about the outlook for Nvidia. But as a group, I still think it's right to avoid them.
Thank you. Gosh, it's so fascinating. I love hearing this so much. But I'm afraid we've come to the last question. Now, I know we're not going into full stock pick mode, but before we wrap up, it is coming into ISA season. Yeah. And of course, no financial advice is given here. Everyone, I mean, as you've clearly demonstrated, you have to do your own research and you have to be comfortable with what you're deciding to invest in. But are there any standout names that you would want in your ISA for 2025?
Yeah, I regularly get asked this question, and I'm going to talk briefly about 3 picks that
Okay.
I'm going to put in my own ISA. But and also I get regularly asked about stocks. How would you structure your portfolio? Now we're working on something that we're not quite ready to announce just yet. So my expectation is we'll be able to release a bit more information about how we're going to evolve what I'm doing now into something that I think investors will find much more useful over the next couple of weeks. And that evolution, I think, as I've said, will I think provide much more help to investors, because it will translate, I think, what I'm talking about from a macroeconomic point of view, from a markets point of view, into things that that may be useful for investors when they're thinking about their own portfolios and what stocks to select and what stocks not to select. So that's the sort of direction of travel in that evolution. But as I said, we're not quite ready to announce it yet. But make sure you subscribe to Woodford Views, because all of that sort of news flow will be announced on the Woodford Views blog. But then, so let me just talk briefly about those 3 sort of ISA picks. Again, these are my own sort of stock selections. The first, well, there are 2 that are UK and one is interestingly a US stock. So the 2 should be reasonably familiar to the audience. One is Barclays. Barclays, which I've owned for quite a time and has performed very well, but it's had a dreadful last 2 weeks. And it's fallen substantially on the back of the Magnificent Seven. Fallen substantially on the back of the Liberation Day announcement from Trump. It's a UK bank, retail bank, but it has an investment banking business. It's trading on about half book value, which is an extraordinarily sort of low valuation for a bank that's delivering 12% return on equity, and I think that return on equity will rise. Its retail banking business has got about a 27% return on equity, so it's quite astonishing, really. I mean, if that was trading as a separate entity, it would be trading on twice book value at least. So it's profoundly cheap, like all the UK banks are. And it's my top pick in that sector, in that market. So I really like Barclays. I think we'll make a lot. I'll make a lot of money in Barclays going forward over the next 1 to 2 years. My second pick is Taylor Wimpey. Taylor Wimpey has had a very challenging 2 years. Interest rates, as everybody knows, went up a lot on the back of the war in Ukraine, because there was an energy price-induced inflationary spike in all developed economies, and certainly in the UK. And that massive increase in interest rates obviously killed the housing market, the new housing market. So they've had a really tough time over the last 2 years, but it's a pretty simple call, really. The valuation is very low. It's got a net cash balance sheet. It's one of, if not the biggest volume house builder in the UK, and it is going to recover strongly on the back of a much lower interest rate environment, which is going to significantly improve affordability. And there are various things that I think will also help the housing market, not least we know that Labour government have got some interesting planning reforms in place. So I think the volume of new house building will pick up over the next 3 years significantly. I think first-time buyers will see a significant improvement in affordability. So I think Taylor Wimpey is going to sell a lot more houses over the next 3 years than it's sold in the last 2. Yeah. So Taylor Wimpey would be my second choice. And by the way, it's got a 9% dividend yield whilst you wait. And the final choice is Micron, which is a bit of a sort of an unusual call for me, really. Micron is a semiconductor business. It's a US semiconductor business. There aren't that many of them. It's an industry that's sort of dominated by Asian and European manufacturers. But Micron is a semiconductor business based in the US, but it has manufacturing operations around the world in places like Japan, Singapore, in China as well. But it also importantly has manufacturing in the US. It manufactures data storage and memory products, memory chips, and they're used in all sorts of different applications. In data centers, importantly, they produce these high bandwidth memory chips, which are used in particularly used in data centers and in AI applications. But their memory, their NAND and DRAM memory chips are used in all sorts of different applications. Now, the semiconductor industry is a very cyclical industry, and it sees quite a strong volatility in pricing and margin. But after a very tough 2 years, when the industry was effectively oversupplied and inventory became too big in the industry, we're now, I think, in a sort of recovery phase. So we're at the bottom of what I think is a cyclical recovery in memory chip pricing, and we're starting to see prices edge up. I think there was a 10% price increase announced the other day by one of the other global manufacturers of memory chips. Now, Micron has had a terrible few days as a result of the Liberation Day announcement. Its share price is down quite a lot. It's trading about, I think, under half its peak share price, recent 3-year share price peak. It's very cheap. It's a very high quality business. I think there's going to be a cyclical recovery in that semiconductor industry, and so I expect its profits and earnings to grow substantially over the next 2 to 3 years. So Micron is my third call.
Amazing. Thank you so much for sharing your insights and your knowledge there. But I'm really sad to say we've come to the end of the show today. We've run out of time. But thank you so much, Neil. Honestly, it was absolutely amazing.
Thank you,
really enjoyed that. And I particularly enjoyed the history of the tariffs. In a way, it's almost cyclical. It's coming back, like most things in the economy. Yeah. It's really fascinating. And thank you, everyone, for tuning in and for being here for today's webinar. I hope that you found it as useful as I have. I think it's been a brilliant session. I am definitely going to be keeping my eye out to see about this product that you're releasing. It sounds invaluable, so I'll be keeping my ears open and to the ground for that. But one thing I know about Neil is that he loves feedback and he loves to hear your questions. So please do feel free to write them at the bottom of this video. And I hope you all have a fantastic weekend. Thank you so much.